I now hand the conference over to Mr. Hardayal Prasad, Managing Director and Chief Executive Officer of SBI Cards. Thank you, and over to you, sir.
Thank you, Nirav, and good afternoon, everyone. On behalf of SBI Cards and Payment Services Limited, I extend a very warm welcome to all of you and thank you for joining us today for the first quarter investor call of FY 2021. I hope you all and your families are staying safe and healthy as we pass through one of the most difficult periods, the COVID-19 pandemic. And before I move forward, I'd just like to advise you that Mr. Ashwani Tiwari, who is the incumbent and who will be joining this company as Managing Director and CEO, has just today landed from New York, where he was posted as country head, SBI Americas. He has landed today and he has joined today, just now from the hotel where he is under quarantine, institutional quarantine. So he would be there with us today. Ashwani, welcome to SBI Card and welcome to India. You're coming back to India after a very long time.
Yes.
So when we spoke in May on the occasion of our Q4 FY20 results, the entire country was in the grip of a comprehensive lockdown, as many of you are aware. However, as the nation gradually goes through the unlock phase and with various policy measures being initiated, green shoots are emerging across the economy, and we see it very, very clearly as we do business and we move forward. SBI Card too has seen significant movement in the business on all fronts. The positive movement, even during such adverse market conditions, is an outcome of many strategic initiatives that SBI Card has proactively embarked on during the past few years, as well as measures quickly initiated as soon as COVID-19 onset happened in March 2020. During the past few years, we have consciously directed our efforts at proactively building a complete thread of digital journey for customers, starting from a new customer acquisition to digital customer onboarding, digital customer servicing, and collections. This has enabled us to operate during this pandemic with minimal disruptions to business. We have ensured 100% uptime of all our platforms, which is website, mobile app, IVR, Ask Leela, while our customer service agents have operated remotely through the cloud dialer, which we enabled it very, very quickly after the lockdown started. SBI Card has not only continued to build emotional connect with its customer through relevant brand campaigns during the period, but also brought relevant offers to our customers. The two films that we introduced during this period were very well received on the YouTube, and one of the film was rated as #2 on the YouTube when we brought in that emotional connect with our customers. Our extensive use of data analytics enabled us to bring relevant and targeted offers for customers. We have partnered with merchants in all categories in line with the consumer spending trends. Many of you would recall during the roadshow, we had mentioned to you that we are a data company, we are an analytic company, and we remain very, very grounded in terms of the way we mine the data and we come out with segmented offers, including the way we monitor our portfolio. The results, which have been announced today, reflect in the month-on-month uptick in spends from April to June. Please remember that from March till about 18th of May, there was a complete lockdown in India and only very little online spends were taking place. Spends today, as you look at it, and if you come and if one looks at our data lake and the real-time numbers, the spends are back to more than 75% pre-COVID daily average levels because of all these initiatives that we have taken during the last 2.5 years. On new customer acquisition front as well, we are seeing a strong rebound. We recently launched the video KYC feature, which will enable us to digitally source new customers even during these times when social distancing is the new normal. This will also bring down the KYC related visits that we do to to a customer, and it is going to reflect in the cost to income as we move forward, and it is obviously a far superior and a smarter way of doing KYC. New customer acquisition is showing strong growth with approximately 80,000 new accounts in May to 181,000 accounts in June. This, in our understanding, if it goes, has been one of the most stellar performance in the credit card industry on the new sourcing. I'm very pleased to say that despite the tremendous challenges posed by COVID-19, we have posted strong results for the quarter based on the strength of sound business fundamentals, which we have always maintained and which we have always said that the company remains very committed towards maintaining portfolio quality, sourcing quality, risk management, and all other functions, including servicing to customers and any interaction that we have. We continue to grow faster than the industry, and our market share on both parameters, spends and cards in force, has risen. We have also seen improvement in asset quality. Number of customers in moratorium has gone down swiftly between April and June. GNPA has improved. However, I would say that these numbers will not reflect the true and color picture because there is a lot of it that has to be that we will be going ahead as the moratorium goes ahead. But despite that, we have shown very, very improved numbers on the GNPA side. With the opening of countrywide lockdown on 8th June, our field collection activities are largely restored. The recovery from charge-off accounts in June 20 was at around 75% of the peak of pre-COVID. One positive outcome of COVID-19 is that digitization is the new normal today. It is across India, but this company was known as a digital company, known as a data company. There is a renewed focus towards cashless and digital payment, which is safer as it requires minimum physical contact. Many of you would have joined from outside India. Today, no merchant, no consumer wants to receive any cash from anyone, and therefore the tap and go and other things are showing very, very good signs of growth. We expect consumer interest in digital and contactless payments to grow further given the social distancing norms. We also continue to closely monitor the situation and realign ourselves to leverage emerging opportunities as also manage any potential business impact. Let me now share some of the highlights. As many of you would have also seen it, SBI Card has delivered a profit after tax of 393 crore, which is 14% higher over Q1 last year. Our ROAA for the quarter ended June 20 is at 6.3%. Our ROE for the quarter ended June 20 is at 28.3%. Secondly, on the market share, as you know, the country has been in lockdown since late March to early June, which impacted our customers' ability to go out and spend, and at the same time, minimal opportunities for our sales team to source new customers. However, I am happy to share that our market share for cards in force has grown to 18.3% from last year's 17.8%, and our market share for spends has grown to 19.6% from Q1FY20 of 17.2%. This is as per the RBI reported data, market share information as of April 20. This reflects despite the testing times of pandemic and lockdown, our customers were able to transact and they utilized digital payments options to generate continued spends. On liquidity and capital adequacy, our liquidity position continues to be strong. We are able to prepay some of our high-cost long-term and short-term borrowings, and with RBI announcing rate cuts, we were able to replace our borrowings with lower-cost debt, which helped us in bringing down our overall cost of funds. Our capital adequacy ratio for the period ended June 20 is at 24.4%. with the Tier 1 at 20.1% 4.3% respectively. Cards in force has grown by 20% YOY to 1.06 crores from 0.88 crores. Receivables have grown by 10% YOY to 23,330 crores from rupees 21,231 crores. Our GNPA is at 1.35%, which is 133 basis point lower YOY as compared to GNPA at Q1FY20. On moratorium impact, accounts in moratorium went down to 1.5 lakh in June 20 versus 12.5 lakhs in May 20, while moratorium balances went down to 1,471 crores from 7,083 crores in May 20. Credit costs in the first quarter also have the impact of moratorium and asset standstill. Our underlying asset quality has always been robust as evidenced by a credit cost in the preceding 2 to 3 years. We have created a collection strategy group. We have created a war room to drive the collection strategy and take swift decisions to respond to the emerging requirement. We are continuously scaling our collection infrastructure under all 3 channels, whether it is field, tele, or the digital side, as we manage the anticipated higher movement of inventory into overdue status. In the past months, we have almost doubled our field workforce from 4,200 to over 8,000, and the tele workforce has gone up from 1,100 to almost 2,000. Additionally, a large number of employees have also moved to collections from across other functions to strengthen the company's collection of efforts. This cross movement of employees from wherever possible has been a very, very good sign in terms of the way we have been handling our collection strategy. We have also onboarded 2 digital communication partners to reach out to customers digitally, including educating customers on the importance of maintaining a good credit score. Now, before we open the Q&A, let me actually also reiterate a few things that our business operations are now running normally. We at SBI Card remain committed towards supporting our colleagues as well as customers while remaining financially robust so that when the crisis gets over, we are in a position to continue our sustained growth journey. Today, SBI Card is the largest pure-play credit card issuer in India. We have deep expertise in India's credit card market as a result of more than 20 years of operating experience. And during these years, SBI Card brand has become a highly trusted and recognizable brand in India. Lastly, as many of you would be aware, I have taken retirement and I will be in office only up to July 31st. As I mentioned at the start, Mr. Ashwani Tiwari will be taking over the charge from 1st of August. While we today talk about the company's performance of Q1FY20, I would sincerely request everybody to keep the discussion only on the company's performance. In terms of any other questions relating to the movement of the managing director or the incoming managing director, we request that these things can be taken through a separate call at any given point of time. And today, in the interest of time, we can very easily restrict ourselves to the performance of the company. Thank you very much for joining once again, and we can start with the Q&A session. All of you have the presentation, and it will be great in case you can ask us any question. I'll be more than happy to share any information that you may require. Thank you very much, ladies and gentlemen.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Anyone who wishes to ask a question, you may press star and 1. First question is from the line of Anuj Singla from Bank of America. Please go ahead. Anuj, may I request to unmute your line from your side and go ahead with your question, please?
Hello, am I audible now?
Yes, sir. Go ahead.
Yeah. So thanks very much for the opportunity, sir. So my question relates to the moratorium accounts. There has been a significant decline in the number of customers or accounts which opted for moratorium in June versus May. So just to understand, for the customer to move out of moratorium, he has to clear all the payment backlog for the last 3 months before he moves out, or is it just the minimum payment he has to make for moving out of moratorium?
Actually, the reason is for the moratorium, as you know, is as per the Reserve Bank of India instructions. What we have done is after this moratorium that ended in June, we have come out on the website an option of a customer to apply for a moratorium, which would mean that if he wants to continue with the moratorium, or even if he was a regular customer but transactor and he wanted to apply for a moratorium for the remaining period up to August 31st, he has an option of going ahead. It has nothing to do with the MAD and all other things.
So will it be fair to assume that the people who have moved out of moratorium, they have actually made a payment towards clearing their past dues, and it's not just the opt-in policy of the company?
No, they would be the ones who have not opted in. The ones who have not opted in obviously get opted out.
Yeah, so it's not necessarily that all these people have made payments as well. The backlog of payments, they haven't cleared.
That's clear in the first answer.
Yeah. Okay. And so secondly, and this is a question more related to the COVID-19 related provision. We obviously took a provision in 4Q of last year. Now, many of the NBFCs which we track, they are providing provision in the 1Q of this year as well, while we haven't provided anything. So is that a reflection of that we are very comfortable with the COVID provisioning which we have done, or we are still waiting for more details on the ground, how the situation pans out before taking a further decision on that?
Here, I think as far as the provisions are concerned, I think because we are losing your voice, I think the question is relating to the provisions.
Yes, sir. COVID provisions, sir. So
we are fine. We have not used the COVID provisions also, and we are fine with the provisions, and we'll see whatever is possible. We'll keep on building onto it. We don't anticipate using the provision as of now.
Okay. And lastly, sir, on the cost of funds, there has been a sharp decline. If you can just elaborate, provide some more color on that, 6.6% in this quarter, that'd be great.
There are two factors to it. One of them is that the cost of borrowings the interest rates are following, so the cost of borrowing is coming down. I did mention in the opening remarks that we have actually replaced the high interest yielding instruments by low interest yielding. That's the second one. And the third is because of the lockdown, the transactors and everybody, the transactions came down, the NEA came down significantly during the initial 2 months, and that is also because of the lower utilization of limits. Overall, the interest costs have come down. We expect that as the business grows, our requirements will come up, but we also don't think that the higher interest rate regimes is going to continue.
Understood. Thank you very much, sir. All the best.
Thank you very much, Anuj.
Thank you very much. Next question is from the line of Shweta Daptardar from Prabhudas Lilladher. Please go ahead.
Thank you, sir, for the opportunity. Congratulations on great set of numbers. I have a couple of questions. So as far as corporate expense is concerned, I'm referring to slide 4. So while the absolute number has doubled, in the slides ahead, you have rightly showed that the POS and online terminal per se has seen drop in corporate spend. So how do we read into these numbers and how do you reconcile?
So, see, we've given the corporate spend numbers. I'll come to the second part of your question. The numbers are right there, and you rightly commented that the corporate spends have grown, doubled from the previous period, April 556 and then 1,244 crores. So it has risen. The corporate card spend has risen. That's a absolutely correct number and data. Now, coming to the second point, where you are saying in some category of spends you see a decline in corporate card spends, can you elaborate on that? Because, where is the data point being read from? Because the corporate spends have increased.
No, so I'm coming to slide 9, wherein in category 3, we have seen that, so presumably corporate spends are largely discretionary spends, which fall in category 3 on slide 9. So that has shown a drop in both online as well as POS.
So, ma'am, category 3, obviously everything was under lockdown. Travel agents, hotels, airlines, railways, everything was under lockdown. So obviously this is not going to grow at all.
Right.
What you are mentioning is category 3, and category 3 is something which was completely affected by the lockdown.
Okay.
And one thing I think we should clarify, the earlier chart you saw corporate spends. On this chart, slide 9, the headline is retail spends. Okay. So it is individual retail customers. It is their spending on these categories of travel which is mentioned here.
Okay. So then my question remains. So then my question remains: what is the mix of discretionary versus non-discretionary as a percentage of total spend?
So do we maintain it that way, discretionary? Actually, from this itself, you can make out what is discretionary and what is not discretionary. The discretionary spend, you obviously will come no opportunity to go and spend. So there is no opportunity. What you would do is you would only make online purchases. So there are a lot of discretionary spends which are actually as you travel or as you are moving around either in the mall or anywhere, you pick up a lot of stuff. So there are other than the departmental stores and the grocery in particular, overall if you look at it, the spends came down significantly. And that is the way it is going. It continued till about middle of May. And after that, as India was unlocking, we saw improvement in a lot of categories. However, the categories which are still not working, which are still under lockdown, you will not see any changes that are coming over here. Airline has started, so we see some numbers over there. The trains have been on and off, so there is no hotels. I don't think are going to open for quite some time. The entertainment industry is down. The hotel and other restaurants are completely closed. So most of the India is closed in terms of that. So we are not seeing over there. Yes, we see improvement in electronics purchases in terms of the consumer durables, and there are a lot of stuff that are. And what we did is that we immediately went ahead with a lot of industry measures, and we brought in many offers on appliances and many other items which would help. Because what is happening during the COVID is people are upgrading their homes. They want better laptops, they want better televisions, they're staying spending more time at home. So they're working actually from the home, and that itself forces them to upgrade their infrastructure, and that is what we are seeing over here today.
So, sir, again, two questions here. So, one, how much of the spend growth would you largely attribute to pent-up demand and or structural? And if you are mentioning that most of the discretionary spends are absolutely down, and rightly so, then what were the triggers for doubling of corporate spend?
Actually, there are two or three things. The first pent-up, not pent-up, but the hoarding demand last week of March. We saw massive amount of spend taking place when India was actually locking down. And then, again, when India started opening up, you initially saw a huge amount of pent-up demand, and we had reached on many days continuously, we were at pre-COVID levels on the spends. So the spends were almost peaking, and there were days when it was even higher than that. But today, if you look at it, it's so stable. The spends are so stable, and they are so gradually increasing that I do not see a pent-up demand. That's all over. The first 10 days, 15 days of the unlocking, the pent-up demand was taken care of. Now what you see is a real demand that is taking place. Otherwise, it will not be a stable demand. In terms of corporate, many corporates have started opening up. The corporate cards will work, especially the T&Es are not going to be active at all because travel is not happening, entertainment is, there is nothing happening either on any of the travel. What we are seeing is more or less vendor payments. So the business is opening up, parts of India are opening up. As they open up, you will find that the business comes back to the normalcy. That's what we are seeing it. We still don't think that we have reached the right levels, but I think with what is happening and what the government is talking about in terms of ensuring that business returns very quickly, we should see good numbers coming back overall in the spends.
Sure, sir. That answers. Thank you.
Thank you very much. Next question is from the line of Nishant Shah from Macquarie. Please go ahead.
Yeah, hi. Congrats, sir. Wonderful set of numbers. Really unexpected. Couple of questions. Number one, firstly, I just want to understand this moratorium treatment a little bit better. So you've seen a very significant kind of a reduction of from 7,000 to about 1,500 crores in the moratorium numbers in the month of June. I'm just curious to understand, like, did these guys clear their entire balances because they had like savings because they were not going out and spending? Or did they repay some partial amount and the remaining amount now continues to be recognized under revolver loans? Because even sequentially, if you look at it, the revolver loan absolute balances have grown about 10%. So point number one is that understanding correct as regards the movement from moratorium, outside of moratorium, back into revolver loans? Is that understanding correct? That's the first question.
I think the first part of your question I answered to Anuj when I was responding on the city, that there is an opt-in clause. If you opt in, you will be part of them. You'll continue on the moratorium, or you can be a new moratorium customer also. If you have not opted in, you are out of the moratorium. It has nothing to do with the payment at this stage, because as per Reserve Bank of India, it has to be offered. So we came out with this option of opting in. So anybody who has done it, and now the moment it happens, they move on the collection side. We start recovering those money, because you have to go and find out, depending on which CD bucket it is in. Based on that, we will initiate the strategy for recovering, whether it's going to be tele, it is going to be digital, or it is going to be field. Will depend that where the account was on 20th of February, and based on that, the actions will be triggered. Aparna, can you just respond to the question number 2?
Okay. So, Nishant, does that answer the question? What was your question number 2? Was there a second part to that question?
No, it broadly answers it. Basically, I was trying to understand that if a loan has moved out of a moratorium, has it been because of a complete repayment, or has it been because the tag of morat is now gone and now he's gone back to being reclassified into his original standard mix, which is either revolver or EMI or transactor? That was my understanding. I think
we have responded to that.
Yes. Second question was around job losses. So yes, like over the weekend, when private banks reported something like only about a 2% kind of a job loss for some of their unsecured portfolios. So for us, because we've been now doing more and more internal sourcing, do we have some kind of understanding as to what percentage of our customers have probably seen a job loss or seen a pay cut? Do we have any kind of like intelligence around that? And if you can give any comments around that, what those percentage?
Nishant, it's all guesstimates. Right now, we do not have any data on the job loss, because you saw that the first unemployment data that came out in April and the one that came out subsequently were completely not in sync. So we really do not have. We are monitoring the situation. We are collecting information, but I would not like to comment anything unless we have a solid information on the job loss, because this data, the variance of the data cannot actually allow me to comment anything on what the job loss is. what we are seeing is that there is very good traction that is coming in on the category A and category B, which is the top corporate, the government, and category C also, where people are saying that they are working from home. They are not saying, many of them are not saying that they have lost the job. They are saying that they say that they have not been paid. They are saying that they are working from home. They are saying that they will pay it. So credible information is still not available with us in terms of taking a position of what would be the severity of the COVID job losses.
So just one follow-up on that. Even for the internally sourced customers, would we not have something like, say, salary credits into the bank account or some sort of insight? Apart from, I completely appreciate that the macro data is all perhaps not relevant to a niche segment like credit cards, but at least for the factual salary credit information or something like that we would have for the internal customers, right?
Nishant, we are a pure play credit card company. We do not have liability accounts. We do not maintain accounts. So we depend on the customers in case he has given us a check-off or a standing order, or he has given an auto debit option, then we are going to trigger it. Otherwise, we have no option on the liability whether he is receiving any income or he is not income, a salary. So what we do is, when we go and we talk to them, we definitely, and if he's asking for some kind of concessions or settlement, we definitely go ahead and ask for some more information in terms of that there is a stress sitting on him in terms of not getting salaries or whatever is happening. So once those things are validated, only then we take a call that what kind of offer that we can give in case he's asking for a settlement or a write or whatever he's asking for. Anybody can ask for whatever he wants, but that does not mean that it can be given unless the information is validated by us.
Perfect. That replies. That provides a very comprehensive reply. Thank you so much. Thanks for the additional disclosures. I'll come back in the queue for more questions.
Anytime.
Thank you very much. Next question is from the line of Anand Ladda from HDFC Mutual Fund. Please go ahead.
Am I audible very well, sir?
Yeah, very much.
Okay. Sir, on the moratorium book which you have disclosed, if you can give some more color, when we look at the data, it seems that bulk of the customer has paid the minimum due and therefore the revolver balance has increased. If you can give some color, is it that the customers are very comfortable to pay 40 odd % rate of interest and that's why they continue to remain a revolver? Or are you seeing customers who are revolver continue to spend more? First thing that, sir. Second, sir, if you can give breakup of your OPEX into few large items, like the OPEX has grown very sharply this quarter. So what part of the other OPEX is linked to the spend? What are the large heads of this OPEX?
I will talk about that in terms of the variable and the fixed cost, operating cost and other things. In terms of the moratorium, I think I'll again take you back to what we replied to Anuj, the first question that we replied. It is opt-in. So anybody here, so there's nothing to do with that. In terms of the balances, if you really look at it, the increase in the balances, one is you're looking at from the percentage point of view, or you're looking exactly from the amount perspective. If you're looking from the amount, there's an increase of about 800 crores on the revolvers. But if you look at it, it looks a little skewed because there was nobody who was spending money, so the transactors were obviously coming down significantly. When the transactors start increasing, you will suddenly find the percentages, what we have always maintained during all our road shows and during the last many years we have maintained that it is almost, it continues to remain almost stable for us, whether it is transactor, whether it is EMI, or it is a revolver. Aparna, would you like to add something to it? And then I think, Nalain, if you could just talk about the OPEX side.
I think the part about that has already been answered by Sir, and I think again, it's just important to go back to what we had said in the earlier call also. Don't look at it as percentages yet, because while spends have gone up, the opportunity for transactors to spend has not gone back to where it was. So you will see that increasing, but right now again, we're still not EAU, so that transactor, revolver, EMI percentages that you're looking at are not exactly correct still.
No, ma'am, because the yield on advances has increased very sharply. To us, it means that the revolver balances has increased very sharply. And when a customer chooses to revolve just paying by 5%, does it mean that the risk in the portfolio has increased?
Okay. So again, I don't think we should look at it as revolver. If you're looking at it as a proportion of the total, then that number, like we mentioned earlier, the split between EMI, transactor, revolver is still not exactly the way it should be, because it does have the revolver in it, and that will make the revolver balance look much bigger. That's number one. Number two is that it's, again, we mentioned this earlier, every revolver does not pay 5% and revolve. Okay, revolvers are people who will pay 20%, 30%, 40% also. So I think the exact correlation that you draw that every revolver is high risk is not exactly correct.
Perfect. Perfect. And the OPEX?
On the OPEX side, Anand, we have three categories of expense. One is the variable type. So variable, obviously, the level of activity it was down, and you can see that from the point of from the spends and the new account side. So we were able to save money there. So the OPEX was lower on account of that. Even on the semi-variable side, things like reward points, etc. One saw that there is since the level of activity was lower, the lower reward points generation as well as lower reward point redemption took place. So that also helped in managing the expenses. Some of the discretionary spend which the company had, we deferred those spends and expenses, and we said that we'll take that at some other point of time and not require at this point of time. Even on the fixed expense side, we've been able to save money. We were able to negotiate rent waiver of some of our properties where during the lockdown, we were not really utilizing them. We also were able to save cost on some other items relating to, say, travel, etc., which is not happening these days. We were able to save cost there as well. So it's a combination of savings in every front, whether it's the fixed, semi-fixed, and the variable. Combined together helped us to lower our OPEX, and which obviously has helped us in our Q1 profit as well.
More importantly, there is massive amount of effort that has been made by the company to ensure that any expense which is not required is actually not made. So we have made huge amount of, because we knew that the income stream is going to be a little stressed for some time till the spends come back and people start taking the term of the EMI kind of products. So it is important for us to ensure that the operating leverage remains very, very strong. And that is what we have ensured, that the operating cost is brought down wherever it was not required, and bring in those efficiency in operations, improve productivity, and see to it that everything is under control. This is despite the fact that we continue to pay salaries to employees, to FTs, and a lot of stuff that we continue to do, because initially the government wanted it, subsequently we decided it, that as the business scales up, we will require people, and as I mentioned to you in my opening remarks, we see everywhere that we have reached almost about 70 to 75% of our pre-COVID levels.
Yes. So our cost income ratio has
So I'll request you to come back in the question.
So it's a part of the same question. Sir, our cost income ratio has declined to 47% from 56%. How should we read this now? It will be going back to 55 odd % level, or it will remain where it will remain?
I don't want you to actually, we are not going to give you any guidance note on anything. We have made ourselves clear in terms of our overall incomes as well as costs. And it is a reflection of that. Going forward, in case the business is going to come back to normal, I think numbers will come back to normalcy. I will not be in a position to give you any guidance notes on that.
Okay, sir. Thank you.
Thank you.
Thank you very much. A request to all the participants, please restrict to one question per participant. If time permits, please come back in the question queue for a follow-up question. Next question is from the line of Ashish Sharma from Enam Asset Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. First of all, congratulations on a good set of numbers, sir. So just on this interest expense part and the cost of funds, So the 6.6% is something as a cost of funds is not something which is sustainable. I think you pointed out already. Just wanted to confirm, is this sort of a cost of funds metric sustainable or not, sir?
There are two or three elements we mentioned to you. One of them is a lower utilization of limit that is not going to be there. The limits will continue to be used as the business returns to normalcy. So obviously, if you are going to use the limits more fully, there is going to be cost to it. However, the interest rates are coming down. We have replaced our high cost borrowings by low cost borrowings. Those are something that the savings are going to be there. And if the interest rates do not move up, and we do not anticipate all of you remain very, very grounded in terms of the liquidity and the interest rate. You would know where the interest rates are heading, whether southwards or northwards. And in the foreseeable future that we are looking up to March, obviously the macroeconomic indicators are going to behave differently. And in that case, it is going to remain definitely not at elevated levels. It's going to remain slightly lower because of the replacement and of the utilization that is definitely going to lead to some kind. If you look at the MCLRs also, the MCLRs have also come down. Now, the State Bank of India has said they are going to come out with a 6-month MCLR. So that's a paper news item. But a lot of things are happening over there. We remain extremely committed towards the way we raise money, whether it is short-term, long-term, bucket-wise, ALM control, everything we ensure that we are at a minimum. Simultaneously, we also have to ensure that we have long-term funds so that we are with the interest rate and asset liability mismatches are not there. And there are certain amount of portfolio that is long-term in nature, which has to be completely funded by long-term borrowings.
Okay. So just wanted to clarify. So normalized cost of funds for SBI cards should remain in the range of, is 7.5% is the right number?
I can't give you any guidance numbers, but I can tell you that I gave you the scenario in which we are evolving. Based on that, obviously it should come down, but where exactly it is going to come and stop is anybody's guess.
Sure, sir.
I can just assure you that the company's treasury desk remains very agile in terms of ensuring that the cost of borrowings are lower. They remain complete. In fact, actually, let me reiterate, which we have told many times. I don't know how many of you would have heard that this company has introduced a robot for managing its ALM. That is one that goes to the sites, picks up the interest rates, finds out daily inflow and outflow numbers, comes out with a very clear daily position, and there is a lot of things that it does, and we are still training it to become cognitive in nature.
Perfect, sir. Perfect. Thank you, and all the best for the next quarter, sir. Thank you.
Thank you very much, Ashish. It's a pleasure talking to you.
Thank you very much. Next participant is Pranav Gupta from Aditya Birla Sun Life Insurance. Please go ahead.
Hello. Am I audible?
Yes, sir.
Yeah, Pranav, you are very loud and clear.
Yeah. Hi, sir. Good afternoon or good evening. Thanks for the opportunity. Most of my questions have already been answered. Just a broad level question, firstly, in terms of the corporate spends. So, it's how are we looking at corporate spends going forward, given that it's a sizable chunk of our overall spend, and how are we looking to deepen our relationships in terms of converting more and more spends from corporates, shifting it to our cards, say something like a utility payment or more of vendor payments? How are we looking at this line going forward?
There's two other things. One is when you are, I think I'll ask Manish, our sales head, to talk to you about that. Couple of things. The utility payments, there are two things. One is the corporate card utility payment, and one is the utility payment that you do. So the utility payment that you do, which is about almost 10 million customers that we have, is part of the retail spend that comes. However, if there is a card given to a corporate, and it's a corporate card, and they're using it, and it's a utility payment card, then it comes under the corporate spends. So vendor is part of that, utility becomes part of that, T&E is part of that. So there is huge, about 5 or 6 major category under which we give the corporate card. The corporate card is a reflection of the business, of the economic activity happening in the country. And the only thing is how quickly you can juxtapose all the economic indicators and see that whether you can do a good corporate spends. So that is what is our motive, and that's the way we are proceeding. If Manish, if you can also cover some of the things on how what we are going to do. No forward-looking statement.
Sure. Since there has been a question before also, so I think it is important to state that firstly, from pure data standpoint, the total amount of B2B spends or payments that happen in the country is quite large. And there is some portion of that which comes onto corporate card spends across the industry. So corporate spends like B2B spends or vendor payments, utility payments, even tax payments. I think we mentioned on a previous call also there are a couple of government types today which directly accept tax payments, and they can also be done through market intermediaries, for example. So corporates are making a lot of these payments. What has happened is that as more digitization opportunities coming, it's coming on the corporate card side as well, as corporates realize that they can make digital payments. So these are the payments which are increasing in the present time. And obviously some bit of domestic travel has been happening for about 2 months now. Domestic flights have been taking off. So while the individuals or employees buying that for their travel has been low, as was observed in another data set from our pages, but the travel companies also, they buy the inventories of tickets to be sold to the public. So that those transactions also happen on commercial cards or corporate cards. So there are multiple use case scenarios for corporate cards, and that is what we are tapping into, which is seeing the increase in the corporate card spend. And we'll continue to work on those use case scenarios because of the opportunity which is there.
Pranav, there's one more thing that is good to remember. As we have been maintaining that there is going to be a big jump in the digital payments, with a lot of cash being converted into digital, and not anybody wanting to receive cash, neither the merchant nor you. If I want to return you money, you want to avoid receiving money from you. Nobody wants to change hands. The same thing is going to happen in the business world. People are going to use the digital modes of payment now more and more. People are becoming comfortable. They want to do it digitally. They don't want, nobody can go to collect money. Nobody can go to actually book business. Everything is happening on the digital side. You place order and you actually make payment through that. I think those are one of the beautiful times that are going to come as you move forward. And therefore, we see that if in case we can very easily ride on this kind of an environment, the corporate spend should see good rise as we move forward, and we see that the business comes back to normalcy.
Right. Yeah, that's exactly what I was trying to understand. So just a clarification. So are we seeing the corporates that we already have on board, which have corporate cards, are we seeing them pay more and more from our cards? Is that a phenomenon which is happening currently? That is exactly what I was trying to understand.
One is that we always believe in creating categories. We already have multinational organizations. We have State Bank of India corporates. We have other bank corporates. We have T&E companies. I think overall, if you look at the bouquet of products that we provide and the kind of companies that we deal with, I think everything is over there. What we also do is that we are continuously looking at the environment to see that who is moving, which sector is moving, or which sector is actually embracing the digital world quickly. The moment we realize it and we find out that these are the kind of sectors which are moving towards the digital payment side, it is at this stage that a very, very strong corporate teams moves in and talks to them and onboards them. And I also a couple of things on the corporate card. It's one of the best products that we have in terms of onboarding a corporate, giving them a limit, giving them a card, and if he wants to give cards to any of his employees or anyone, it's completely self-servicing. Our operations is so strong in terms of the the linkages of the spend with the ERP of the organization, that anybody, a maker checker concept or an admin of that corporate can come and generate cards from us. And all of them can be digitally sent also. Most of them can be digitally sent. The virtual cards are digitally moved from one place to another. So I think overall, it's just a question of industry embracing such a fabulous way of handling business and doing business.
Great, sir. That answers my question. Second question, on
I'll request you to come back in queue for a follow-up question.
That's my second question. But yeah, sure. Cool.
Thank you. Next question is from line of Ravi Singh from HSBC. Please go ahead.
Hello. Yeah. Firstly, thanks for the additional useful disclosures. My question is on slide number 9, where you have provided mix of your retail spends across category 1 to 3. So can you share what is the broadly mix across these 3 categories? And as the mix evolves more in favor of category 1 and 2, will it impact the income models of interchange, for example, and flexibility on OPEX to manage the overall profitability?
I think Girish will talk to you about it, what is the breakup of these 3 categories. More importantly, which category is growing is far important than anything else. So we are monitoring everything on how the movement of spend is taking place under what category. The granular information that comes from our data lake is phenomenal in terms of tailoring our strategy to see to it that we are optimally present and we are there all the time. Girish, if you could just cover some of the questions.
So you're right. The weightages have moved a bit pre-COVID versus post-COVID, but the movement is higher when you look at the online state. Because the category 1, which is your departmental store, grocery, fuel, health, utility and education kind of categories, there is a good growth of close to 23% from a pre-COVID level. So that has increased. So earlier the weightages were around 75 to 77%, are now that contribute to almost 88 to 90%. Okay. Given that, and that has happened because the drop in the category 3 has been fairly sharp, which is the travel category in that sense. Okay. Yeah. On the point of sale, the movement has not been that strong as online. So category 1 used to be almost like 53 to 55, and now it is it's close to 58 to 60% in terms of weights. So that has not moved much because if you look at the degrowth on the POS side, it is 32 and 41 and 85. So now the travel category has degrown there also. In the POS stage, it used to contribute anywhere between 6 to 8, actually 4 to 6% depending on the seasonality. Mix is down to almost a percentage of 1 to 1.5% at this point of time in terms of weightage. But that will pick up over a period of time because we see travel definitely picking up in some point of time. Hotels as a category might take some more time to pick up, but travel will pick up. People will start traveling as more airlines start to open up. International travel has not started as yet. That is also yet to open up. So it will not be at the earlier levels, but we believe that different categories of travel. So we have got, for example, from travel agents, we have done some offer with Make My Trip. We learned that it is at this point of time, pilgrimage travel is becoming slightly more popular. People are doing road travel. So there are different kinds of travel which will become popular, but we are keeping an eye on this category.
One more significant thing that has happened and has come to our notice is that people who are at the consumers or our card holders who are 55 and above, they have started using online aggressively. I think a very potent sign over there. These people usually were only on the POS, and today you find that they are becoming very comfortable in using the card through online means. I think India is truly moving towards a digital world.
Sir, to the question, are interchange rates or other revenue opportunities different across these three categories?
The MDRs are different for all categories. Every category has its own MDRs.
Okay.
Just one clarification on this one. So, for example, it might happen that online health and travel will have the same interchange rate. Okay. So, what that means is different categories is each of the individual can have a different thing. But category 1 does not mean that category 1 will have a same rate or category 2 will have same rate. These are categorized with respect to the growth and degrowth at this point of time to show you the consumer trend.
Okay.
I mean, blended, you say everybody says no, MDR is 2. But obviously it could be 1.91, it could be 2.01 or 2.3. So, but more or less, actually, every category will have its own.
Got it. Thank you, sir. That's helpful.
Thank you.
Next question is from Jaimin Shah from RWC Partners. Please go ahead.
Hi, thanks for taking my question. Just more on a subjective question. Do we have a sense on how much of your...
May I request you to speak a little louder?
Yeah, can you hear me now?
Yes, sir.
Yes. More on the subjective kind of qualitative understanding, how much of your cards are under some form of subscription payment, which you see on a monthly basis or, quarterly basis, could be education or could be kind of, some sort of entertainment like, whatever, Netflix or something. Because those would be, the most high kind of customer. And I just wanted to understand, what is the kind of repeat, recurring kind of spend there, if you have any sense.
Okay, so you are right, but the subscription need not be basis monthly number also, because insurance payments, if you see, are paid once in a year typically. So you have a lot of customers paying insurance payments in the month of March, because that's what is very popular. Second thing is, yes, monthly payments, which is people on utility bills and doing standing instructions that's a fairly large number because we have that. The third thing is we also do a lot of insurance-based cross-sell. So we have a product called CPP, which is again a monthly annual payment for which the customers make. It would be we have not disclosed this number of how many people are there on monthly or others, but if you look at our active rate, because that is what is a basic indicator, even in the worst period of April, May, June, we have had on an average 40% plus customers who have been active on the card in that month for making a retail transaction. So, and that headline number is also given in one of the charts.
Okay. And spends, do we have a qualitative answer for spends as well?
Won't be able to give you that specific number as of now, but we measure it by number of customers, basically percentage of customers who use the card every month, because that is what is most critical. Spends on an average, full month spend is in any case reported.
Okay. Okay. And second question, again, more on a qualitative basis, is on the on page. Remember in terms of loyalty point and bonus points, page 23. I would assume travel would be, big kind of category pre-COVID. Given that travel has kind of come down, I just wanted to understand where is most loyalty kind of bonus being kind of spent, and thoughts on how people use that on a recurring basis versus pre-COVID.
Some of it was covered by Nalin when he spoke about the OPEX. So on loyalty and other things, he did rewards and other things he covered, and why it is lower and other things like that. Otherwise, it's not just that even if it is coming down, just to ensure that people, keep on spending and they have the right offers. So assuming that we are saving somewhere because there's no spend happening in some categories. But what we are doing is that we are offering them products and services which are relevant to him today. What is the point of actually asking? Even if I have given you a lounge access today on your card, you are not going to use a lounge today. How many times are you going to travel? You may be traveling every week. You are not traveling even for 3 months. You may not have traveled. So I think what we are doing is over and above. We are saying that we would like to provide you some additional. The card doesn't provide that. My product doesn't provide that. But just to ensure that there is loyalty, and we want to, give it back to the consumer also, so that he realizes that, okay, if I am not, for example, Book My Show is not working. For the best card, I offer a Book My Show at 500 rupee. You can actually buy tickets on our elite card. You are not going to use it. So I want to compensate and help my customer in seeing to it that this company is responsive in terms of what it is going to do with its card holder. And I think that is why the whole reward point and loyalty structure will not give you, I can't give you straight answers. It is a mix of huge amount of effort that the company is putting in to ensure that we keep on interacting, remain engaged. And I'll also tell you that we are a transaction company. So it doesn't matter. Active rate is one part of it. I want you to transact many number of times with me. As again, you spend 5,000 rupees, I'm okay with you. But if you spend 500 into 10 times, it's much better for me, because it becomes a habit for you to come out with that card. Every time you take out the card, you are going to say, okay, use my SBI card. I think the transaction company is more interested in those kind of things. And that's what we try and push. The contactless film that we came out, it is now the 8th most watched film on YouTube. Why is it so? It must be relevant. People feel that I need to make payment through the contactless procedures, and that's what is more important for us. Let him do 100 rupees transaction. It is okay for us, but he must do transaction. I think I look at it from that prism and see whether we are engaged with the customer and what kind of loyalty we also provide to the customer, not just he provides to us.
Correct. So essentially, the bonus and loyalty is kind of getting more fungible now.
That's right. I fully agree. Thank you.
Okay. Thank you.
Thank you very much. Ladies and gentlemen, due to time constraint, we will take the last question from the line of Pankaj Agarwal from Ambit Capital. Please go ahead.
Hello, sir.
Hi, Pankaj.
Hello. So, sir, what is the average duration of your EMI loan book?
It's about 9-10 months is our average.
So there are different categories of EMI product. Some range, some are short term. They will range between 3 to 5 months.
Blended for the company.
Yeah. So just over a year, because there are certain products where we have over 3 years, but generally most of the loan book majority of it will run off between 8 to 9 months. A part of it on an average basis may go above a year.
Okay. And have you seen any trend where people are converting their spends into EMI? I mean, any change in that pattern in recent quarters?
Pankaj, can you just repeat your question? Sorry.
No, I'm saying that have you seen more people converting their spends into EMI in last 3-4 months?
Okay, Girish will answer that.
So Pankaj, there is actually in last 3 months, the trend has been more towards, as I was mentioning earlier, more towards from high ticket size items like travel and others. It has moved to lower ticket, high transaction items like utility bill payments. People are paying general groceries and those kind of things. So actually what we have seen is the trend is slightly lower. So we used to have, but it is not that much low. I would say there is a 5 to 7% movement on the other side because of the lower, the movement towards departmental stores, groceries and that kind of spends, which are non-discretionary in nature. As discretionary spends will come in the future, we believe that this, whatever that EMI volume is, that will continue to grow. We have in the last 3 years, we have seen both the things happening. We have seen more and more percentage of spend converting into EMI. In fact, what people have been doing is they have been converting their statements, looking at the overall balance and converting that also into EMI. So there is the movement in the past has been higher. However, in this COVID period, it has been there is a 5 to 7% on the other side.
Some programs that you are running on the appliances and
Actually, what if some programs which I will tell you, because we have run some programs with Amazon, even with Flipkart, there was a program which we ran for 4 days where we looked at all the large appliances and most of them on EMI. So today, whatever consumer durable spend is coming, 80% of that is coming on EMI. However, as you've seen in slide number 9, consumer durable online is up, but consumer durable on the POS side is still yet to pick up. So as the spends will start to come in those categories, we will see that that EMI volume also continue to grow.
So it's a function of your cash flow position. Nalin mentioned to you, some will take it for 3 months, some will take it for 15 months, some are taking. So the blended is less than a year.
And sir, one final question. Any difference in moratorium numbers between EMI customers and normal transactors?
No. So I think we mentioned that even last time, there is no real difference. Moratorium anyway is at a customer level, not at a balance level, and there's no real difference. So not difference take up rate or anything else.
But you can also talk about that moratorium type of customers who have actually taken it.
So I think we've done a split of that earlier also, and even in the version 2 of the moratorium, even though the numbers are relatively small compared to the earlier one, the distribution of these 150,000 customers of moratorium remains very much in line with the portfolio. Okay. There are no clusterings that are seen even in the smaller number of moratorium customers.
No, all kinds of customers are taking moratorium initially. People who in the last 24 months. They suddenly said we want a moratorium. They repaid it. There are customers, very large number of customers. They may have defaulted even one day. They are not delinquent. Maybe he has delayed the payment by 10 days, 15 days, but he has paid. They have also taken moratorium. So I think everybody was rushing towards the future, which was not very sure. And that is why many of them came and said we want a moratorium. So it's very difficult to say that what kind of customers are taking it, whether it's the EMI kind of customer, transactor. Transactors taking it suddenly, never they have done it. So I think we are in a time which is we are in a flux. We'll have to wait. The only thing I can assure you on behalf of the company that we are on top of it. We are working very hard to ensure that everything is very well managed. We know what is happening around in terms of our income streams, our expenses, our spends, our acquisition strategy, our portfolio management, our offers that we give, our upselling and cross-selling that we do, and in terms of the delinquency, that the way we have been managing it, we are ensuring that there is nothing. I think, in fact, actually, even when the management is working from home, many times it is really working more than maybe 10 to 12 hours and ensuring that there is no stone left unturned to see to it that the company remains strong, and the confidence that each one of you, all of you have reposed in us. We are extremely thankful, and we maintain those kind of confidences that all of you had reposed when we came out with our issue at a very, very difficult time of COVID flaring up in India. So thank you very much once again. We look forward to your interactions. I'm sure many of you last time also had asked for some closed group interactions. We'll continue to interact with you and disclose as much as possible within the norms and see to it that you have a fairly good bandwidth and understanding of the company. Thank you very much, ladies and gentlemen.
Thank you very much. On behalf of SBI Cards, that conclude this conference. Thank you for joining us. You may now disconnect your lines.
Thank you, Ashwani, for being patient enough to listen to all of us.
Thank you, sir.